Following on from part 1 of risk management in Forex trading, we'll now take things a step further by looking at additional key concepts. Risk tolerance is a factor traders must address. Risk tolerance represents the value of your account you're willing to risk on each trade. Determining your risk tolerance can be daunting, particularly for newer traders. 1% of the total account equity on each trade is considered conservative risk, while 5% signifies reasonably aggressive risk exposure. 2%, however, is generally a standard metric most observed, but this largely depends on your experience level. A common mistake many newer entrants make is overlooking the importance of the economic calendar. Most calendars will underline each release with a projected impact. CFD markets tend to respond to news releases with medium to high impacting markers. Prudent traders are aware of the risks of trading around news time. They know that executing new trades just ahead of a release can place positions at unfavorable prices. They also know to defend active positions against adverse movement around news time. Now, leverage and margin is also crucial understanding. The mismanagement of leverage is a common error among Forex traders, a practice that can destroy an account. In the right hands, nonetheless, leverage is a formidable ally. Margin refers to a small amount of trading capital held by your broker to gain leveraged exposure, which is a fixed ratio provided by your broker. It's important to note that leverage rates differ depending on the products traded. So, margin is a portion of your account that is held by your Forex broker to ensure you have the means to cover any potential losses. Margin is often called initial margin or used margin and is taken away from free margin, which represents the available funds to trade. Think of it as a deposit to trade, which, assuming risk is controlled by the trader, will be returned once the trade is liquidated. The leverage ratio offered by Forex brokers essentially controls the margin required. Each broker has a maximum allowable leverage, for example 50 to 1, 100 to 1 and 500 to 1. Dividing the leverage ratio highlights the margin percentage required to trade. So 1 divided by 100 for a leverage rate of 1 to 100 equates to 0.01 or 1% margin required to trade. Or for a leverage ratio of 1 to 30, we divide 1 by 30 to reach 0.033 or 3.33% margin required to trade. As you can see, margin and leverage are closely related. Higher leverage equals lower initial margin and lower leverage equals higher initial margin. It's vital to understand that account leverage will not change unless you do so through your broker's client portal. And finally, what is a margin call? A margin call occurs when a trading account no longer has any free margin. This is the margin level. As long as our account equity level remains above margin, our used margin, we will not receive a margin call, which is a request from the broker to bring margin deposits up to the initial margin level to keep existing positions open or manage your existing positions by closing some. What's really important to understand, though, is the broker's stopout level. If equity drops beneath 100% of initial margin, the margin level, this is when your MetaTrader terminal turns red, and you run the risk of hitting the broker's stopout level. As the name suggests, this is where positions are automatically closed to avoid the account going into negative territory where you could end up owing the broker. The stopout level for clients on FP markets is 50%. What's this? So, FP markets work with a 50% stopout level, which means if equity falls below $500, should your initial margin be $1,000, FP markets automatically closes the first most losing position. To wrap things up, leverage certainly has its place in the Forex market if controlled in a professional manner, which should be detailed in your overall trading plan.